Welcome back to Investing Talk Podcast. We are so glad you've joined us for another fascinating exploration of a company that's, well, really trying to transform the sustainable energy sector. Today, we're zeroing in on Gevo. It's a name you might have heard generating some discussion, especially if you're tracking the renewable fuels market. Our goal today is to really examine Gevo, give you a clear picture of its financial health, its unique spot in the industry, and what the future might hold. We'll get into their innovative approach to sustainable fuels and explore the factors that could either, well, push them forward or create some real hurdles. Think of this as your guide to understanding a company right at the forefront of decarbonization. And before we jump in, if you find these explorations valuable, please take just a second to subscribe, like, and comment. It genuinely helps us bring more of this content to you. And if you feel like supporting us a bit more, maybe consider buying us a coffee. Every little bit helps keep these insights coming your way. Okay, so let's start with the basics. What exactly is Gevo?
It's a U.S.-based company, renewable chemicals and advanced biofuels, headquartered out in Colorado. Their main business model is built around this idea they call the circular economy. They use biotechnology to transform sustainably grown stuff, mostly corn, actually. And they turn this corn into a whole range of products, things like high-value protein, isobutanol, and importantly, sustainable aviation fuel, or SAF, as it's often called. They're really focused on creating these drop-in fuels that, just work with the infrastructure we already have. It's a pretty big point. Beyond that, they also run one of the biggest dairy-based renewable natural gas facilities in the U.S., an ethanol plant that captures carbon, and a special facility turning alcohol into jet fuel. This circular economy idea seems pretty central. Can you maybe paint a clearer picture of how Gevo actually does this? What makes it different from just, using corn?
Absolutely. So for Gevo, that circular idea means getting the most value from, well, every part of a corn they process. Sustainably grown corn, that's key. They pull out the high-value protein first that can go into animal feed. Then the sugars left over, they ferment those into their fuels and chemicals. And even the CO2 that comes off their ethanol process, they capture that too. So it's this multi-product approach trying to minimize waste. That's really the heart of their circular model. It's designed for both sustainability and hopefully better economics. It's quite a vision. And you can start to see the strategy showing up a bit in their financials. For the first quarter of 2025, Gevo reported total operating revenue around $30.9 million. Now, that's a really noticeable jump, about $25 million higher than the same quarter last year.
Wow, $25 million increase year over year. Where did that mostly come from?
Yeah, it was largely what you call inorganic growth. It came mainly from their acquisition of Red Trail Energy earlier in the year. That facility added about $23 million in revenue just in February and March alone.
Okay, so acquisition-driven growth for now. What about profitability?
Well, they reported an earnings per share of negative 0.09 cents for Q1 2025. So yeah, still unprofitable on a GAAP basis, standard accounting rules. But that was actually a little better than analysts were expecting. And they are making progress towards positive adjusted EBITDA. That's a key metric to watch.
Right. Adjusted EBITDA gives a sense of the underlying operational cash flow, stripping out some non-cash items.
Precisely. And looking bigger picture, it's worth pointing out that Gevo actually holds more cash than debt on its balance sheet as of the end of Q1. That suggests a pretty conservative approach to leverage, which is, frankly, quite important when you're investing as heavily as they are in building out these big new facilities.
That conservative balance sheet, yeah, that's definitely a positive point during such a capital-heavy build-out phase. But let's really get into what makes Gevo stand out. It's a competitive space, rapidly changing. You mentioned their drop-in fuels and proprietary tech. What does that really mean for their edge against, say, the big energy players with huge R&D budgets?
That is a really crucial point. You see, a lot of alternative fuels require massive, expensive changes. New engines, pipelines, whole new supply chains sometimes.
Right, a huge hurdle.
Exactly. Gevo's drop-in capability potentially lowers that barrier dramatically for airlines, for trucking companies. It could give them a much quicker path to market adoption than maybe more disruptive technologies can achieve in the near term. It feels like a more pragmatic path to cutting carbon. And beyond just being drop-in, their specific technology lets them produce low-carbon ethanol, and especially these sustainable aviation fuels, with a significantly lower carbon intensity score.
Carbon intensity score. That connects to the credits, doesn't it?
It does. That lower score allows them to generate valuable carbon credits under schemes like California's low carbon fuel standard. Being able to generate those credits alongside the fuel sales, that's potentially a very powerful dual revenue stream. And like we said, acquisitions like Red Trail Energy are boosting their production capacity, adding proven assets.
So it's like they're selling fuel, but also selling carbon reduction itself. That's quite interesting. How does Gevo fit, then, in the wider market context against the bigger, more established biofuel companies?
They really position themselves as an emerging challenger, focused specifically on these renewable hydrocarbons, not just the traditional ethanol market. And the industry itself has some pretty major tailwinds right now.
Like what?
Well, there's growing global demand for low-carbon transport fuels, obviously driven by climate policies. Plus, you have a significant expansion of government incentives, tax credits like Section 45Z, for example, that directly support biofuel producers like Gevo. And there's more regulatory focus on life cycle emissions, basically, the total carbon footprint from start to finish. That boosts the value of the kind of carbon intensity improvements Gevo aims for.
Okay, so the policy environment seems supportive.
Generally, yes. Now, there are always risks, of course. You could have supply chain hiccups or volatility in feedstock prices like corn, but the overall macro trend, it does strongly support Gevo's core business model. If you compare them to, say, a much larger player like Ness, well, Gevo clearly lags in current scale and market share. That's obvious.
But they differentiate how?
They differentiate with that proprietary alcohol-to-jet technology, that ATJ process. And importantly, unlike some other pathways, their process is designed to be somewhat feedstock flexible. It can potentially use different types of sustainable alcohols, not just one specific kind.
Ah, so not just locked into corn alcohol, potentially.
Potentially, yes. That flexibility could be a real advantage down the line. It might reduce their vulnerability if the price of one particular feedstock spikes. And it lets them target these more specialized, high-value markets like sustainable aviation fuel.
Okay, that makes sense. The technology sounds promising. The market trends look favorable. But Gevo isn't without some pretty significant challenges, are they? Despite the prospects, their financials, as we touched on, show these persistent net losses.
That's correct. And those losses are largely down to very high R&D spending and the huge capital investments needed to actually build these new production facilities.
So cash burn is a real factor.
It absolutely is. It remains a considerable concern until those big commercial operations are fully built, running smoothly, and, generating substantial revenue. They are very much in that heavy investment phase right now. And if you look at their stock performance over the past year or so, it has, generally underperformed compared to the major market indices.
Why is that, mainly?
It seems tied pretty directly to delays they've had in scaling up production and, frankly, those ongoing operating losses. Now, you do see occasional spikes in the stock price, usually after news about a new partnership or maybe some positive government incentive news. But the overall market feeling seems to be this mix of cautious optimism, definitely blended with some skepticism about their ability to execute on time and on budget. Execution risk is the term you hear a lot.
Okay. And the reliance on tax credits, is that a big risk factor?
It's certainly a notable one. Any changes there could impact their economics. And for investors, it's also worth remembering no dividends are being paid, which is, again, pretty normal for a growth company plowing everything back into the business.
Right.
But it means the return, if it comes, has to come from stock price appreciation. And that stock price can be, quite volatile. That's common for many small-cap renewable energy stocks.
So definitely not a stock for the faint of heart, it sounds like. It requires close watching. Given that volatility, what's maybe the one specific thing you'd be tracking most closely to gauge if Gevo is gaining momentum?
For me, it really comes down to concrete progress on commissioning their net zero production facilities, particularly Net Zero 1.
That's the big one they're building now.
That's the flagship project, yes. So consistent updates on construction timelines, sticking to the budget, and then critically showing it can operate efficiently once it's turned on. Seeing actual revenue growth coming specifically from these new facilities when they come online, that will be the ultimate proof point.
That makes perfect sense. Okay, given all that context, the potential, the risks, the volatility, how is the broader market actually feeling about Gevo right now? What's the general sentiment? Well, analyst sentiment, for instance. It seems quite mixed, doesn't it?
It really is. You've got some analysts hold ratings pointing directly to that execution risk we've been discussing, but then you have others who see a speculative upside if the commercial rollout really picks up speed.
And what about, say, retail investors? What are you seeing on social media platforms?
Among retail investors, the sentiment often leans more speculative, often quite bullish, actually. But even there, you see an acknowledgement of the risks, especially around the timing of cash flows.
I saw a comment on X the other day that seemed to capture it. Someone said, GVO could be huge if their net zero plant delivers next year. but I'm not holding my breath until I see real revenue.
That perfectly sums up the mood, I think, that cautious optimism waiting for proof.
Interestingly, though, Gevo's stock price has shown some notable strength very recently. As of mid-June, I saw it closed up nearly 3% one day and had actually risen about 21% over the previous 2 weeks. Trading volume was up, too.
Yeah, there's been some positive movement. Technical analysis might suggest there's potential for more gains there, but it also carries a warning, right? Short-term traders might look at a run like that as a chance to take profits, which could cap the rise.
Right. So volatile.
Exactly. Which brings us back to those future catalysts. What could really shift the balance here? The commissioning of those net zero facilities expected late 2025 into 2026. That's undeniably the big one, number one.
What else?
Signing new, significant long-term supply agreements, especially for SAF or their renewable natural gas. That would be huge. It signals real market buy-in and predictable future revenue.
But the risks don't just disappear once construction starts, do they?
Not at all. The risks persist. You could still face delays or, crucially, cost overruns during the commissioning and ramp-up of these new plants. That could put even more pressure on their finances, their liquidity, and as we mentioned, any major shifts in government policy or the value of those subsidies could still impact demand for their products and their profit margins. So, yes, there's clear, exciting potential here, no doubt, but it absolutely comes with significant execution hurdles that are going to define their path over the next year or two.
Okay, so let's try to wrap this up. What does all this mean for you, the listener interested in Gevo, or just in the sustainable energy space generally? We've looked at a company with some genuinely innovative proprietary technology. They seem to have a strong competitive angle in a growing market for sustainable fuels, particularly SF. And we've seen robust revenue growth recently, even if it was mainly from an acquisition. Plus, that point about holding more cash than debt, that's a positive sign during this expensive expansion phase.
But to put it all in context, it's clear Gevo represents a speculative opportunity, and it comes with high inherent risk. While their financials show those ongoing losses driven by heavy R&D and capital spending, the path towards hitting positive adjusted EBITDA is definitely what management and investors are focused on. The company's future success really hinges heavily on successfully commissioning Net Zero 1 and then securing those vital long-term customer contracts.
So ultimately, Gevo offers you some pretty interesting exposure to that fast-growing sustainable aviation fuel market. It's got innovative tech platforms. But its current financial position, combined with those still somewhat uncertain commercialization timelines, it means this is a story you really need to watch closely. It's a narrative of high potential, definitely, but deeply intertwined with significant execution challenges.
Which really leads to an important question for you to think about. As Gevo pushes forward, how is that delicate balance going to play out? The balance between government incentives, their own technological execution, and just raw market demand. How will those factors ultimately shape Gevo's trajectory in this incredibly dynamic, rapidly evolving clean energy landscape? That's something definitely worth pondering as you continue to explore this fascinating space.
Thank you so much for joining us for this look at Gevo. We really hope you feel more informed and ready to think critically about this company and its prospects. Until next time.